Good afternoon. Yes, it's officially afternoon, 12:01. Welcome, everyone, to our Petoskey Strong Information Series, the 2021 Economic Forecast. I'm Nikki Devitt, president of the Petoskey Chamber. And for those of you who just joined the event and were immediately brought to the program, don't worry, we will have some more networking opportunities for you after our program concludes. So what I'm going to do right now is I'm going to invite to our stage Suzanne of PNC Bank. She is the AVB branch manager and also the PNC certified women's business advocate. So we want to join her up here with us, and then we will get our program underway. So now we just wait.
Thanks, Nikki. Good afternoon,
Suzanne.
Good afternoon, everyone. I'm Sue Liesma, Banking Center Manager at the PNC here in Petoskey. So thank you so much for taking time out of your busy schedules to listen to our guest speaker. Our speaker is Amanda Agati, Senior Vice President, Managing Director, and Chief Investment Strategist for PNC Financial Services Group. In this role, she leads the team which establishes overall strategic and tactical asset allocation guidance of client portfolios. She oversees the evolution of investment processes, provides thought leadership on key investment issues, and authors numerous recommendations. She also performs research and analytics that drive the overall investment recommendations of the firm, while also managing the firm's asset allocation modules. Amanda is frequently interviewed on CNBC and in financial publications, sharing her insight and expertise in the markets and the economy. I can assure you you'll get a lot of valuable information out of her presentation. And Amanda, I want to personally thank you for taking time to spend with all of us here in Northern Michigan. So without further ado, I will turn it over back to you.
Okay, great. Can you hear me and see me okay? Let's make sure we get the tech working here. Awesome. Okay, I'm seeing in the chat that we're good to go. So that's always a good way to start things off. Well, thank you so much for that kind introduction. I am so delighted to be with all of you, albeit virtually this year. As we were getting ready for showtime, we were talking about the weather. So I'm based in Philadelphia and kind of in the midst, or at least at the tail end of a blizzard here. For us, we have about 10 inches of snow, and it's quite a doozy. We're effectively snowed in, and just north of the city here, they're talking about 2+ feet of snow. So very different dynamic here in the Southeast Pennsylvania, Philadelphia area relative to where you all are, but it sounds like you all were spared. So that's great news for all of you. A little bit of a luxury, if I can even describe it that way. We don't get snowstorms like this, so it's been very beautiful to watch, and also I guess maybe a little bit of a bright spot in the midst of an ongoing pandemic, that I don't have to get out there and shovel the driveway and plow myself out to be anywhere. I get to speak with all of you here right from my home office. So what I thought I would do today is, I mean, we could be here all day. And so what I thought I would do is share a few thoughts, maybe more than a few, high-level thoughts around the ideas and topics that are really top of mind for us as we start off the new year here in 2021. There is a ton to unpack in terms of what's going on with the economy and the markets, and of course, you know, what's happening with the pandemic. And so this will not be a full around the world tour in terms of all the things that are on our mind, but I'll try to squeeze in as much as I can. And then, of course, I look forward to all of your questions during that portion of the program later. So let's just jump right in. I don't have slides to show you. You're just going to have to look at my face and, you know, as we talk through some of these things. But what I thought I would start with is just a quick snapshot of what we're seeing in terms of the economic growth backdrop. The rest of the presentation will be much more kind of in the weeds around markets, but I always feel like starting with the economic backdrop is a good kind of context for where we might go from here. So you know, the first thing I have to say is We have never shut down the global economy, literally never shut it down in response to a global pandemic. There have been pandemics, of course, over the eons, and markets and economies have had to wrestle with them time and time again. But the COVID-19 pandemic is the first time in which we've actually shut down the global economy in response to a pandemic. And so that has had important implications for how we assess the economic growth backdrop and also assess the path forward. We've had to get a little creative about some of the activity indicators that we track to really determine the pace and timing and progress of reopening the economy. And so that has meant we're shortening up our line of sight a lot relative to the normal indicators that we would look at, things like industrial production, monthly retail sales, even GDP growth, which is lagged over a 3-month period and revised a number of times. I can't remember what I ate for lunch yesterday, let alone what happened 3 months ago. And so if you just look at some of those longer cycle indicators, we think it really doesn't give you a clear picture of where we are in terms of the status of the recovery and the path forward. So we're looking at things like open table restaurant reservations by state, as well as by country, both here in the US and abroad. We can get access to that type of data. Weekly retail sales, public transit data for major city usage, even weekly airline passenger volumes. And so without getting through all of the details on each of these indicators, no matter which one you look at, they're somewhere in the neighborhood of 30 to 50 or even 70% off of pre-COVID levels or February of 2020 levels. And so the bottom line here is we're hashtag not out of the woods yet. The consumer may still be consuming, but still, as you know, this virtual presentation is a perfect indicator of, we're still very much living in this stay-at-home world. And so that does have important implications, especially given how far and how fast markets have rallied here into the new year in terms of this pace and rally that can continue. Can it really keep up? And I think, you know, I'll share some thoughts around, you know, what 2021 might look like from that perspective. So let's start by digging into the equity market a little bit and talking about volatility. At this point, I think everybody should be aware, at least to some degree, about the retail trading army saga, the Reddit raiders that kind of took Wall Street by storm last week in a very narrow subset of equities. You know, this is not something that we necessarily predicted in terms of the 2021 outlook, but it is definitely a symptom of something that we talked about extensively, and that is this high volatility regime that we find ourselves in. Now, 2020, obviously, we broke all kinds of records as it relates to market volatility, both on the equity and the fixed income side. But because we started off 2021 with still a lot of uncertainty in the system around reopening the economy, valuation sitting at fairly elevated levels, we'll talk about that in a second, earnings growth expectations being really high, and this vaccine distribution and deployment story really starting off on a much slower footing than what we would like to see, we think that 2021 will definitely be another high volatility year. Now, this does not mean that we expect a very bearish outlook or an outcome by any means. We don't expect necessarily negative market returns this year. We really think that the high volatility regime should be volatility cuts both ways, that big price swings are more the rule rather than the exception. And certainly January is a very good example of that. I can't believe January is over. It's been such a whirlwind, but it definitely was a high volatility backdrop. In the case, we can get into the details on kind of my thoughts around the Reddit raiders and the retail trading army, but when you look at the activity in the options volatility market last week, we actually broke a record on Wednesday. So a very simple gauge that we use to assess market volatility is the CBOE VIX index, or volatility index. And that saw a 62% spike in one day. If you think back to the spring of 2020 at the onset of the pandemic, we started to see pretty much the multi-asset class universe implode all at once. That is, correlations converged to basically one. There really wasn't a safe haven in the publicly traded markets. But back then, we certainly saw spikes in volatility, nowhere near what we saw last Wednesday. And so I think it's notable to call that out, even though it is still very much focused on a subset of equities. It did contribute to a significant bout of volatility in the equity markets. I think reassuringly, though, when things like this happen, when spikes in volatility occur, we always want to get a sense of what's that contagion effect? What is that spillover effect? Do we see anything on that horizon? And so reassuringly, we haven't seen a subsequent move in some of these other asset classes where we might start to see some signs of stress show up in the financial system. So again, at the onset of the pandemic last year, we started to see pretty meaningful signs of stress in short-term fixed income markets. Basically no movement over the last week or so. All appears to be fairly calm in fixed income. And so we haven't seen this correlation rising backdrop materialize, which is good. And we haven't really seen a rally in store of value assets either, which would suggest that perhaps the consensus view is a bit more negative and worried about a potential market correction in the short run. So at the end of the day, we do think the volatility backdrop will continue to be an important part of the story for 2021, but what's happening with the retail trading army is still very much focused on a narrow subset of equities. All right, so with all the chaos of the headlines and this talk about the retail trading army, what's frustrating as a strategist is you wouldn't even know that we were in Q4 earnings season by all of these headlines. This whole retail trading phenomenon has completely dominated the market narrative at the expense of the underlying fundamentals. So I want to give you a few thoughts on where we are in terms of earnings season. So fourth quarter earnings season is actually coming in much better than expected. So despite the challenges that are still sitting out there in the economic growth backdrop and the pace and timing of vaccine deployment, we're actually seeing fourth quarter earnings season come in really strong. So what does that mean? It means that we're seeing fairly significant upside surprises or an upside beat rate relative to where we started the beginning of Q4 earnings season, to the tune of about 1,350 basis points. So this massive beat rate that kind of came out of nowhere. It's also contributing positively to a slight acceleration in earnings revisions for all of 2021. Naturally, it's setting the stage, putting the bar a little bit higher for a year-over-year growth rate as Q4 is coming in better than expected. So the expectation now for 2021 earnings growth is just about 23% year-over-year. That is a very high bar. And you might say, all right, well, sure, we have very easy comparisons when you look at Q2 and Q3 of last year. But I'm still kind of worried in the back of my mind that if we don't get this economy reopened and fast, that 23% earnings growth expectation for the S&P 500 may be very difficult to achieve. It's still too early to call this one, but I think the key message here is that earnings growth expectations are very high for this year. We've set a very high bar for ourselves. And given where valuations are sitting, I think there isn't a lot of wiggle room. We really think that the story for this year in the equity markets is the baton being handed off from a valuation multiple expansion story, which really dominated all of 2020, to an earnings growth story in 2021. Why do we think this? Because what we're seeing in Q4 results, even in the face of these really positive results and upside surprises, we're seeing very lackluster reaction out of stock prices. It's really this dynamic of buy the rumor and sell the news. And so with valuations sitting where they are, it's not enough of a catalyst, even with strong underlying fundamentals, to keep the rally in certain stocks going. So when you combine that with the high volatility regime and the choppiness that we've seen over the last few weeks in particular, we've really given back some meaningful ground relative to the beginning of the year. We're not quite flat on the year as it relates to the S&P 500. And today, with the strength in the market, we're up a little bit, but we're only up about a percent or two. And so long way to go, I guess. That's the key to reopening and the path forward. We got a long way to go. And January didn't really help us so much in terms of forward progress. So let's shift gears and talk a little bit about valuations. I threw out this idea that valuations are really kind of elevated, and I don't think it's a stretch to say that valuations are indeed stretched. We are not in the camp that valuations are necessarily in bubble territory, but no matter what index you look at, we're certainly at elevated levels. If you look at things like the S&P 500, if you look at the MSCI World ex-US, which is a proxy for the developed world on the equity side, even if you look at the emerging markets index, all of these are at least 30% above their respective 10-year forward PE averages. And when you look at small cap, or the Russell 2000 is a good proxy for it, they're sitting at forward PEs in excess of 40 times. 40, not 14, not 4, 40. So very significant move in terms of valuation multiple expansion. But I think the key here is that valuations are always a relative game. And so you have to frame valuations relative to other asset classes and also relative to what's going on in the macro landscape. And so if you think equities are a little expensive, look out when you take a look at investment grade fixed income. Two very simple, basic measures of valuation to compare equities and fixed income both handily favor stocks, and that's the yield to duration ratio for investment grade corporates is basically sitting at an all-time high, and the treasury yield to the earnings yield on stocks is actually double its 10-year average. To really be bullish on fixed income here, you have to have part of your base case investment thesis of a move by the Fed into negative interest rate territory. We do not think that that is the plan and the course of action that the Fed is likely to take. They have reiterated that as well. And so, we really think that fixed income is likely to be challenged here, particularly in 2021, but also over the next few years with rates pinned at such low levels. And so from a valuation standpoint, this is really what happens in equities versus bonds when you have rates pinned at such low levels and you continue to have an enormous amount of policy accommodation, both on the part of the Fed, but also on the fiscal side of the equation coming into the system. So our message on valuations is definitely that equity valuations are elevated, but are not sitting at extreme levels, especially when you take a look at fixed income. So an important key there. And I think that will ultimately, this is something that we're having a lot of conversations with our clients about right now, resetting expectations for what fixed income portions of portfolios can do. The returns and the yields that we've enjoyed in the past aren't necessarily what we will enjoy going forward. And so what does that mean for asset allocation positioning? And then too, when you have rates basically sitting near zero, you don't end up with as much ballast as what you would like to have in fixed income. That is, the closer to zero rates find themselves, the more volatility you see. And so again, it's an important conversation and in resetting and perhaps right-sizing asset allocation positioning for this year and over the next few years. All right, so let's talk for a few brief minutes. I kind of dipped a toe in the water on fixed income outlook. Let's get into the weeds a little bit on where we are from an interest rate backdrop. So we're sitting at the last check before I got on the today's session with all of you. The 10-year was sitting at just about 111, 112. We're basically sitting now at the highest level of the pandemic. There's been really, the story for 2020 was very much range bound in terms of interest rates specifically. The 10-year made a run at trying to break through 95 basis points a number of times over the course of last year and really failed to sustainably move above it. We saw some fits and starts, but at the end of the day, it kept falling back. So finally, in January, when the Dem sweep scenario was solidified following the Georgia Senate runoffs, we saw a fairly significant backup in rates. And so although we've had some volatility in rates, just as we have had in the markets over the last few weeks, we do think that this is about as good as it gets in terms of interest rate moves, or at least market-driven interest rate moves this year. So we don't expect the 10-year to move materially higher from current levels. A bunch of reasons for this, but I'll just give you a couple quick ones. The Fed, repeatedly says they're not even thinking about raising rates, that the Fed funds rate is going to stay at zero for a quote unquote significant amount of time. So we don't expect a change on the policy front. And we also think their ongoing quantitative easing operations should also put a lid on longer term interest rates. They continue to be very, very active in fixed income markets, providing needed liquidity. And so we think that that will put a structural lid on interest rates for the foreseeable future. The other thing you have to talk about is interest rate differential. So what's happening in the US relative to other parts of the developed world? And so based on where the 10-year is sitting, we're now at the second highest interest rate across the developed world for the 10-year. I think second to only Iceland, if I did my math right. So fun fact for you there. Meanwhile, 9 countries today have a 10-year that is sitting in negative yield territory. So massive striking differential between US rates and other parts of the developed world. And so we continue to believe that that's going to attract additional foreign investment, foreign capital into the US, and will act as another additional pressure on longer term rates. And so it's a tough slog. We're very optimistic and hopeful about the recovery in 2021 and a market rally on the equity side of the equation. Very, very tough to get excited about the path forward for fixed income for the foreseeable future. All right, so let's shift gears and talk a little bit about politics. Dare I dip a toe in the water on this one? I promise we'll keep it to purely market-related implications of the recent Dem sweep, and then we'll try and wrap it up. So, I have to kind of take a step back and say the single most popular question that we got over the course of 2020 was, is the market going to immediately collapse if there's a Dem sweep scenario? That is, Biden wins and the control of Congress changes hands, that we don't end up with a divided government scenario. There was so much investor concern and angst about that scenario playing out. And then, of course, fast forward to the Georgia runoffs, the first week of January, we solidify the Dem sweep and the market rallies. And so go figure. So a quick history lesson, maybe a little helpful in explaining why everybody was so worked up about it. And then I'll give you a few thoughts on why the market actually was very comfortable with that outcome. So if you go all the way back to 1933 and kind of break up the average annual S&P 500 performance by partisan control or scenarios. There's a bunch of permutations and combinations. Believe it or not, the worst case scenario from a performance standpoint is not the Dem sweep, but it is the second worst performer. So there is somewhere in the neighborhood of a 300 to 400 basis point relative performance give up versus most of the other scenarios with a Dem sweep. It's still not too shabby, though. I think that the number was something like 9.4%. I'd take 9.4%. That's not a bad outcome at all. Believe it or not, the worst case scenario from a performance standpoint is actually when a Republican controls the White House and the Dems control Congress. And it really is like the perfect storm of gridlock. That's the expectation there. And so from a performance standpoint, the S&P 500 managed over this long horizon, managed to only generate about half of the performance. So sub 5% in those various scenarios when they occurred. And so we really do think that a lot of the history certainly has been in the back of investor minds about what the implications for a Dem sweep scenario might ultimately be. the market rallied, and it really comes down to something very simple and yet frustrating, again, from a strategist perspective. I always joke that the market is very much like my 5-year-old in a candy store, just craving that sugar high from more and more stimulus to come into the system. And so really the interpretation by the market following the Dem sweep was we were likely to get a much bigger stimulus package and much sooner, and more likely to get it done quickly in terms of the approval process because the Dems had complete control. And of course, in very short order, you saw 1.9 trillion plus spending package kind of be brought to proposal here. I mean, there's still a lot that needs to be worked out there, but I think at the end of the day, that was the most important key to the market rallying immediately following the Dem sweep. So dangerous words to say. It's a little bit different this time, right? Past performance is not necessarily an indication of the path forward, but I think it really comes down to not being out of the woods yet, still being in the midst of this pandemic, still needing to bridge the gap, and this idea that fiscal stimulus for sure is going to come back into the system to help effectively bridge that gap and bail us out. The unfortunate part about a Dem sweep, at least from a market, very selfish market standpoint, is that tax hikes are back on the table and likely across the board. I think my own personal view on this is that I'm hoping it's much more of a 2022 event. So it's more about timing as opposed to if it's going to happen or not. In 2022, our expectation is that the economy will be on much stronger footing, that will be well beyond the pandemic by then, that the population will be vaccinated. And so even though there's no scenario where tax increases are good news or welcome news for the market, we think that the market could manage to handle that kind of an impact, not so much here in the very short run. So in the fall, when we were asked questions about, well, what's going to happen on the tax policy front, what does that mean for the earnings backdrop, we had kind of back of the envelope done some math on it. And so if we were to repeal the Trump tax cuts fully, and again, this is not necessarily our base case, and frankly, the rhetoric coming out of Washington is not nearly that draconian right now, which also gives us hope. But at that time, that we're trying to assess the worst case scenario. And so at that time, it appeared as if about 11 to 12% hit to earnings growth would be that kind of worst case, or perhaps even base case back then, scenario. So if it were to go into effect in 2021, and or it was to go into effect but be retroactive to the beginning of 2021, we thought that it would be about an 11 to 12% hit to earnings growth. Now, I said earlier, the earnings growth expectation for 2021 is almost 23%. So it's basically cutting that earnings growth number in half. I think the good news is, based on what we're hearing out of Washington and policymakers, is that that is not going to be what ultimately comes to fruition, that it's more likely to be somewhere in the middle, so that perhaps it would be a 5 to 6% haircut. Still not good news, but certainly better news than that 11 to 12% hit. And so we absolutely have it on our radar, because any headwinds to earnings growth, as I said earlier, because we have such lofty expectations here starting off the new year, any additional headwinds to earnings growth, not good news for the market, given where valuations are sitting. And so that's an important thing for sure to have on our radar. At the end of the day, we can talk about policy changes, we can talk about the change in control in Washington, we can talk about a whole host of potential headwinds and tailwinds impacting the market. But we still believe, if you had to twist my arm and say, what is the single biggest variable in the equation here for 2021, I have to go with COVID. We absolutely believe COVID remains in the driver's seat in terms of the path forward this year. And why is that? Well, because we think it has important implications, and has already, for the magnitude and timing of fiscal stimulus, right? That story about much more stimulus and much earlier. and that need still being fairly significant, COVID's going to dictate much of what happens on the policy front there. COVID's also going to dictate and be in the driver's seat as it relates to monetary policy and rates. It is the key reason why the Fed continues to say we're not even thinking about raising rates. And so we think that will dominate monetary policy narrative for much, if not all, of 2021. It also, of course, because we're living in the stay-at-home world, continues to dominate the trajectory and the pace and timing of reopening the global economy. So very critical to the story of GDP growth, not only in the US, but abroad, and very much interlinked to the trajectory of earnings growth. I know I'm beating this dead horse, but it's just so critical in our view to the path forward, what happens on this earnings growth front. And then ultimately, it continues to impact and really dominate market performance and leadership. It was the key to the story last year and drove this really significant disconnect between basically large cap growth and everything else. And we think it will continue to play an important role this year. So the market continues to churn between the stay-at-home trade, which in our view and our definition is larger, growthier, and really focused in the sectors like healthcare, technology, communication services, and staples. And at the other end of the spectrum, the go outside trade, so smaller and more value-oriented cyclicals. And so we continue to see this very significant, much wider than what we would see in kind of quote unquote normal market cycles, this bifurcated environment between it being all one way and all the other from a performance standpoint. And at the end of the day, that comes back to this COVID story and the market wrestling with what does the reopening look like and what are the key beneficiaries in this more fully reopened economic backdrop. So let's kind of wrap it up here and make sure there's time for questions and networking. And I'm just going to simply say, on a bright spot, COVID cases are certainly slowing down. We're seeing COVID case curves plateauing in many parts of the US and also in other parts of the globe, which is good news. But the flip side is that the vaccine rollout is certainly going much slower than the consensus for the markets has expected, and certainly on my own 2 cents, where I expected us to be at this point. And so we definitely have on our radar this idea of a potential tail risk for the markets, that we either don't get this economy reopened fast enough, or like what we're seeing in other parts of the world, have to take some additional steps around restrictions or even lockdowns. And so it is not a high probability in our view, but it is a non-zero probability. And so again, with that, where valuations are sitting, so perfect example, S&P 500 sitting at a forward P of 23 times, the market is effectively pricing for perfection when we know the backdrop is anything but that. And so to finish here, I think that the key message is we continue to believe that the markets can forge a positive path higher this year. But in the next quarter or two, we think things are going to be pretty choppy, if not potentially range bound, as the market wrestles with all of these variables that we talked about today. But as we get closer to reopening, and as we get closer to a more complete vaccination of the population, with all the stimulus in the system, we really do think the back half of the year can be very, very strong and really sets a very, very strong stage for 2022. So with that, I will stop there and hand it back to see if we should start the Q&A portion of our session.
Thank you so much, Amanda. That is a tremendous amount of information, and you did address a little bit of what's going on in the Q&A, but we do have a couple questions there. So I'm going to go through them as well so you can give a direct answer. And so we'll start off, it looks like, so first question, M1 money stock has shot through the roof over the past year. What effect is this expected to have on the economy as it reopens? Will the Fed taper their balance sheet in lieu of raising rates?
Well, so, as I said in my comments, I don't think the Fed is interested or anxious to make a lot of changes at all on the policy front. They're very clear about keeping rates effectively near zero. I think although I'm not the economist for PNC, I think I am tracking the economists' outlook pretty well, and their view is we don't see a rate change in terms of policy until 2023. So a long runway of rates kind of staying pat. The tapering of the balance sheet one is such an important question because it really makes for a challenging backdrop. You know, the minute the Fed started signaling that they were going to taper their balance sheet, this is pre-COVID, like Q4 of 2018, you saw a really significant market correction. And so it absolutely is on our radar, but I just think it's a little bit premature to start talking about tapering of the balance sheet. And even if they start to do it, it's not a 2021 story. It's probably not even 2022. I think more likely is a pause and a stabilization in the balance sheet. And then with a lot of signaling and a lot of advance notice, a very, very slow start to taper. You know, the balance sheet is north of 7.4 trillion now. We're absolutely in uncharted territory here. And so they're going to have to be very careful about the unwind and the tapering. They may never really be able to normalize it, kind of given where they are. I think the timeline on it is going to have to be so stretched out. So very important to the story, but we don't think that it's likely to come into the equation as a headwind or a negative for the market outlook in 2021 and beyond.
Excellent, thank you. Another question that we're looking at as far as when the global supply chain is going to calm down, you know, return to that more normal level, specifically container costs and available capacity, air shipping capacity.
Well, I would love to have my crystal ball all shined up for you and say it's going to happen on March 4th, because that is such it's a great question. It's such an important piece of the story. I think there was a lot of concern last spring when we first went into this. I characterize it as a little bit of a rolling brownout in thinking about an electricity grid related to the global economy. There was a lot of concern back then that supply chains were going to come to a screeching halt. We definitely saw disruption. We definitely saw fits and starts on it, but we've come a long way since then. We're starting to see inventories build. We're starting to see a bit more activity, but we're not fully reopened. And that's really the key to the path forward, right? We're seeing significant restrictions go into effect in the UK, in parts of the Eurozone, in Japan, a few parts of Asia, not necessarily China per se, but a few parts of Asia are starting to look at that again. And so we are nowhere near normal. And I think that's an important gauge for the timing of supply chain disruption settling down. I think we've come a long way. I don't think it's necessarily a headwind per se to achieving the earnings growth expectations for 2021, but it's absolutely something that we have to keep on our radar. And the other aspect of it, which actually I think is the more impactful at the moment, is where do these supply chains ultimately move to, right? Over a many year period, the entire last cycle, there's been this shift of global supply chains to China and Southeast Asia. And so we put all of our eggs in one proverbial basket there. And so we've seen a lot of talk, but not a ton of movement here in the short run about diversifying away from supply chains being solely focused in China. I think we'll see more of that. I think it will take a few years. You can't move a supply chain overnight. Key beneficiaries will definitely be parts of Southeastern Asia. But really, if you think about the globe, there really aren't that many other places that have the infrastructure, that have the labor supply, that have the cost structure that China does. And so we'll see some shifts there. We'll see some disruption potentially, but I don't know that that's really a core part of the story going forward. I wouldn't say that we'll see this massive onshoring in terms of a manufacturing renaissance or supply chains coming back to the U.S. I don't think that. I'm highly skeptical that comes to fruition. But hopefully that helps frame out thoughts on supply chain.
Excellent. Thank you. What do you see in regards to real estate? So we have so many businesses deciding that they don't need office space. They're downsizing because of people and they can work from home. Where do you see that going?
Well, we have REIT exposure in our portfolio. So in full disclosure, we are not extraordinarily negative on REITs as a sector. We think there are important reasons to have REIT exposure in portfolios. And one of the biggest one is the yield pickup. In a growth-starved and yield-starved world, where can you find reasonably priced yield? Pockets of REITs certainly look that way to us. I totally agree with you, though, that there are some ongoing structural challenges here in portions of REITs that may never fully recover. Mm-hmm. The areas of REITs that we do still feel very positive on, and it's really a function of the underlying fundamental story, but also as a function of exposure to some secular growth trends that we think have taken hold and been accelerated by the pandemic, namely the digital transformation. But pockets of REITs that look attractive to us are 5G related infrastructure, data centers, data warehouses, towers. Though that's really kind of where we want to be exposed in REITs. You're right, though. The challenges in retail, office, I think in parts of healthcare REITs in particular got hit really hard as a function of the pandemic. You have to think, just as the pandemic has forced, whether we like it or not, a lot of technological adoption, innovation, and advancement, you have to think that this will force a reset on the supply-demand now imbalance around retail, office space, et cetera. And so, we watch these areas very closely relative to our exposure and portfolios. Unfortunately, with not fully reopening this economy, not being out of the woods yet, we haven't seen a lot of improvement in the underlying fundamentals of REITs. It's going to be very challenged in 2021. It's not an area that we're looking to aggressively add exposure to. Really struggling for what that catalyst is to get the full asset class kind of re-going again. So very tough out there for sure.
Absolutely. I want to give people a little bit of time to get back to their tables and network a little bit. And you're going to stick around as well. So if they have some one-on-one questions, I feel like that would be a great opportunity. So we'll throw it back to the tables here in a minute. Amanda, thank you so much. And I'm glad that you didn't have to travel. That's one benefit we have of this. We have this incredible economic forecast from you for our region, and you have, a snowstorm over there, and you're where?
Exactly.
Down here. So
it worked out great.
It worked out fantastic.
It worked out great.
And a big thank you to PNC as well. They are our Connecting Women in Business marquee sponsor. So this event today, we're very happy that we could have this for our entire membership to view, and we have recorded it. So anybody who had to jump off early will be able to see it as well. So we're going to take things back to the floor, and I encourage you to spend a few minutes on the rest of your lunch hour, everyone, to say hello to Amanda if you have questions, or just another familiar face on a screen. So thank you again very, very much, Amanda. And before I forget, if you didn't pull it down from the chat, you will be able to, and we will email everyone as well, the good, the bad, the ugly, and the top 10 investor themes. Absolutely fantastic. Very informative. Let's go back to the floor.